Good afternoon, everyone. Thanks for joining us on time. Let's wait another couple of minutes for the rest of the participants to stream in. Okay, time now is 12:02. Let us begin. Very warm welcome to all of you. Good afternoon. I'm Darren Chan from Philip Securities Research, and on behalf of Poems, we would like to welcome capitaland India Trust. So from capitaland India Trust, we have the CEO, Mr. Gauri, with us here today. So we are pleased and honored to be graced by his presence. And yeah, just some quick housekeeping rules before we begin. There's a Q&A tab at the bottom. Just please feel free to type in any questions you might have in that Q&A tab. I already see one there. So please type in any you might have, and Mr. Gauri will get to the questions right after his presentation. Yes, so without any further ado, let me hand over the time now to Mr. Gauri. Yeah, Gauri, please. Thank you so much.
Thank you, Darren. Good afternoon, everyone. Really appreciate you taking time off to get onto this call and give us the opportunity to discuss about Capitaland India Trust, which has been a fairly long listed trust in Singapore. Since 2007, we have been listed in SGX, and for almost 10, 12 years, it was the only public access to India properties for any listed security investor. So without further ado, let me quickly jump into what Capital and India Trust is. I'm aware some of you may have good in-depth knowledge about who we are, what we do, but some of you might know we might be new to you. So I'll try to use the next 15-20 minutes to take you through and give you a brief overlook of what we are in India, what we do, what is our kind of secret sauce, how do we think we differentiate ourselves from competition. So once the presentation is done, we will then open up it for Q&A. So Clint, like I said, has been in India for a very, very long time. The sponsor has been in India for 30 years. So 2024 was the 30th year anniversary. Clint assets have were acquired and listed in 2007. As of today, we are among the most diversified real estate or business trust with properties in India. There are three other business REITs in India, but they are far more localized than we are. So we get a lot of diversification benefits. As of today, we operate about 22 million square feet of income producing assets. We have potential to develop within our own business parks an additional 7 million square feet. And we've also lined up through the forward purchase program, which I'll go into a little bit more detail later in the slide deck, for about 6 million square feet. The forward purchase program is something which is very unique to Clint and is extremely accretive to unit holders. If you look at our current metrics, our market cap is about 1.4 billion. And based on what is the latest trading unit price, we are about 6.4% dividend yield. We are present across 5 major cities. Starting from south, it is Bangalore, Chennai, Hyderabad, Pune, and Mumbai. And we are present across 3 asset classes, the bread and butter, IT parks, IT slash business parks, 10 we operate, four industrial logistics facilities, and four data centers, which are currently under development. These are our most current results. For the full year 2024, we did about 26% year-on-year increase in assets under management, largely driven by assets which we are able to pre-lease and improve the valuation. That reflected in a NAV increase of about close to 19% to 1.38. Our NPI is up by about 14%, quite a healthy margin. DPU was up by about 6%. There were certain one-offs and a situation in one particular property which went from master lease to an operating lease. So because of which, the NPI growth couldn't fully reflect in the DPU. We hope that will catch up, this year in 2025. Committed occupancy on a same store basis about 95%, among the highest you will find across our competition in India. Gearing is healthy at 38.5. Most of our property portfolio is green certified 94%. We do expect it to increase further over the course of the next 3 to 4 months. And from a sustainability linked loan perspective, we have 65% of our loan book is linked to sustainability, which is something which we hold very dear to our heart, and we follow the master plan of the sponsor CLI 2030 master plan in terms of our sustainability commitments. This is the results in a bit more granularity. We have about 19% Sing dollar increase in terms of property income. Like I mentioned before, a 14% increase in terms of NPI growth, and the distributable income is up by about 6%. And like I mentioned, this was largely due to one asset which we went from, which was master leased. It was an industrial asset wherein we had to terminate the master lease because of challenges faced by the lessee, and we are operating the asset on our own. So this year we should be able to significantly improve the distribution to unit holders. That should flow through by the end of this year. This is the DPU since listing. It is not a linear growth, but if you see the most recent years, especially since 2013, it has been fairly active growth. Even during the COVID years, we were able to maintain a high dividend. The slight dip in 2023 happened because of a $150 million private preferential offering that we made to unit holders that kind of diluted it a little bit. We should get back on in terms of the growth trajectory further. This is in spite of, if you look at the chart of the INR exchange versus the Sing dollar, it's a secular downward trend. If you look at the last 10, 12 years, it has depreciated by about 3% year on year. That is something which we already model into our financial models and investment models when we make the acquisition. So despite this depreciation of the INR, we have been able to maintain our DPU at quite a healthy level. It has always been greater than the 6% mark for a significantly long period of time. This is the portfolio occupancy that we have across all our parks. Like you see, most of our parks are above 90%, except for one which we recently acquired last year in March 2023. That was acquired. We acquired the asset at about 46% occupancy. We got the benefit of the asset in the acquisition price for the lower occupancy. We expect that to get ramped up over the course of this year, and by end of this year, we expect Evans to the last one out here to sort of get to about 70-80% stabilization. And subsequent to that, you will have a further increase in the occupancy, which is already at a very healthy click. We have a very good, diversified client base. If you look at the top two tenants are in the IT service sector. Applied Materials is in the semicon industry. Amazon, as you know, is in e-commerce. Synchron is in IT consulting. Renault is an auto manufacturer. Bristol Myers Squibb is a healthcare company. UHG is again in healthcare. Lennox Soggen is in BFSI. So if you see, there is it's not, there's this perception that Indian business parks are skewed more towards IT services, but that's not the case anymore. There is a good diversity of tenant mix. It's not just restricted to ID services, but you have alternate industries also coming and picking up a significant portion of the business parks of late, what we call as the global capability centers. Uh, Pegatron, which manufactures contract manufacturer for Apple, no manufacture and assemble their Apple phones in our business in our industrial park. In fact, last year they did more than $1 billion of Apple iPhone exports from within our own facility. So this is in terms of our growth trajectory. I'll just share this slide first before I move on. We expect to grow to about 31 million square feet over the course of the next 3 to 4 years. These are commitments which we already have identified or already we have made. It's a healthy mix of business parks, data centers, and through the forward purchase program, industrial and business parks through the forward purchase program as well. We have already identified which are those assets and what is the pipeline. Our development pipeline is largely in the most attractive markets of Bangalore and Hyderabad. Just for context, India had close to, according to CBRE, 2024 was the best performing uh, office market ever in India. 79 million square feet of absorption that happened. Of that, the biggest increase has been into the greatest absorption has been in the cities of Bangalore and Hyderabad, which is where our divestment investment pipeline or development pipeline is concentrated. Similarly, even the forward purchases, if you look at it, it'll largely be skewed towards the attractive markets of Hyderabad and Bangalore. We continue to strengthen our presence in the most attractive markets. Notwithstanding business parks, we also have a good pipeline of development in the data center. We have committed 4 data centers in the 4 key markets. The first market and the largest market being in Navi Mumbai. We have a gross capacity of 104 megawatts being developed. The first 51 has been fully developed and has been pre-leased. We expect to a global hyperscaler. We expect the hyperscaler to pick up the additional 53 megawatt data center in Navi Mumbai as well. In terms of Hyderabad, the 41 megawatt is expected to be completed by the middle of 2025, and we are having healthy discussions with enterprise clients for that as well. So the assets in the data center space which we have developed has seen a lot of traction in terms of leasing, and we'll discuss some pointers in terms of yields later. But as of today, for accessing data centers in India, Clint remains to be the only public access, through the listed markets. We are the only source of access for data centers in India, which is quite unique. And the leases that we are signing are the largest such engagements or agreements being signed with the hyperscalers in India at this point in time. Just a quick sort of a primer on what is the forward purchase program and why it makes it unique. For context, India is a developing market. The availability of core products, unlike in Singapore or in the rest of the advanced markets in Asia, the availability of good quality core products is very limited. So what happens is whenever a core product comes to the market, there is tough competition among the REITs and other institutions, which drives up the price and reduces the cap rates or the rental yields that one can generate out of these assets. So what Clint decided was that we will not go and compete with the rest of the market once a product is already stabilized, but we will go and compete for products at a slightly earlier stage, but at the same time de-risking ourselves from the risk of stabilization. So that was the motive of this. And the second thing is that in India, land parcels and locations are held within HNIs and families and developers in a closed knit circle. Availability is very less, but those same developers do not have access to design or the quality of tenants that we have. So it is kind of a symbiotic relationship. We agree to partner local developers in developing their land parcels into world class grade A business parks, and bring world class quality tenants, AAA tenants to those business parks. And in return, the developers agree to sell these same assets to us post stabilization at a deep discount to market. Now we get easily a 15% discount to the fair market value of these assets. So our going in yields are in the range of 9 to 10%, as against 7.5 to 8.5%, which the other competitors do. Not only that, during the development phase, we are able to lend construction finance the developer for the construction of the property, and we are able to generate 11 to 15% interest income, which is very very accretive to investors. From a risk perspective, we don't take the leasing risk, because what we enter is into separate contracts. We enter into a loan documentation for the construction financing, and the developer is legally bound to repay the loan when the loan matures. And on the other side, we enter into a binding forward purchase agreement, which has an obligation on us to buy the property if and only if it achieves a certain milestone in terms of the leasing. So we are de-risking the portfolio from leasing, but at the same time, we are able to purchase the property, a stabilized, good quality grade A property with grade A tenant at a 15% minimum discount to market price. So that is something which we've been successfully doing since almost the past 11, 12 years. Since 2013, we have been doing this forward purchase program. And a significant portion of our portfolio has been developed through this program, and we have been successful at it. Uh, Quick outlook on the data center business. Some of you may not be aware, India contributes about 20% of the digital content, but it only has 3% of the digital storage capacity. Not only that, India is a critical chain, a critical link in the whole data center chain. All data center, all data that gets into Southeast Asia and the other parts of Asia from Middle East, Africa, and Europe has to pass through either a Mumbai or a Chennai, as is visible in this chart. So India becomes a very, very critical cog in the wheel for data center business. Not only that, as of today, India is the cheapest place to develop. If you compare on the cost of developing 1 megawatt data center facility, India, the cost of developing that in India is significantly cheaper than any other market, including markets like Johor Bahru in Malaysia. And India also has an interesting domestic demand in terms of, be it front end content like your social media content, or delivery content such as your OTTs, the Netflix of the world, or the digital storage and processing, the AI and ML processing, the LLMs and SLMs that are there. So on all these counts, the attractiveness of data center in India is really high, which is reflected in the large hyperscale take up that we have had. So the first building that we have developed is fully master leased by is fully leased by a global hyperscaler, and it'll be a state of the art, close to it'll be a tier 3 plus or close to a tier 4 facility with very low latency. Um, what you have realized is, in the data centers that we have, we are able to achieve roughly about a 10.5%, stabilized net yield, development yield. And if you look at the revenue contribution that we expect from this portfolio over the course of the next 4 years, it should grow from 4% in 2025 to about 25% in 2028. This is assuming we don't add more data centers or add more business parks. As of today, what portfolio we have and what pipeline we have, we assume on that basis it is going to be getting to about 25%. We also are going to divest about 33% of the data center stake to a vehicle that is going to be sponsored by CLI. That 33% stake sale is going to ensure two things are achieved. One, it shows to the market the value realization that happens because data centers are a very, very attractive asset class which are trading at significantly higher multiples than any other asset class in the infrastructure space as of today. So we will have a significantly large value realization which will be sort of shown to the market through the sale. And number two, it also provides capital for us to continue to grow our pipeline and reinvest into our existing development projects. Um, we also have, like I said, have significant focus on sustainability. Like I mentioned, 30, 40, 99% of our portfolio is green certified. So the 94% was as of December 2024, and 99% is as of this month. 39% of renewable energy is used for our own consumption as a landlord. We have a 5-star rating on GRESB. We have our own 29 megawatt solar power plant, which we have set up to power our parks. So therefore, our sustainability journey is something which will continue to grow. This is something which we use as a key differentiator in attracting the best tenants. For example, the MTB 6, the most recent development in Bangalore, the building is expected to get completed by end of March, but it has been pre-leased to Applied Materials, who is in the semiconductor industry. And one of the main reasons why we are able to attract them to take up that whole building is because of our commitment to sustainability, which is a key metric for them when they decide on which landlord to partner with. So that's in brief what Clint is and what we have been doing. I'll be happy to now give it back to Darren and see how we can take and answer some of the questions.
Yeah, thanks, Mr. Gauri, for the insightful presentation. Let's head to the Q&A. There are many questions ready. Yeah, so the first one is, for the REIT investing in Indian properties, you issue a Sing dollar bond at 3.5%. Historically, the Indian rupee has depreciated by approximately 4% per annum against the Sing dollar over the last 20 to 30 years. So what is the average excess return of these Indian properties relative to the combined cost of funds in Sing dollar above?
Yeah. Okay. Sing dollar bond was issued at about 3.7%. It is trading now at 3.5. That's a small correction. In terms of depreciation, yes, it is. It ranges about 3 to 4%. More recently, we believe it is reflective of somewhere about 3.5%. In terms of our overall return, if you look at our historical portfolios, we would have clocked something in excess of 15% in INR terms. And these are portfolios which were set up way back in the year 2000 when everything was cheaper. As of today, when we look at new investments, we target something which is in the range of about IRR of about 13% plus. We look at going yields which are, like I mentioned, in the 9 to 10% range, and an overall return which is in the range of about 13% or 13% plus. So that's where the band for us in terms of investment returns are. So we are able to, despite the depreciation of the currency, we are able to consistently maintain a yield which is in excess of about 6% for the unit holders, while at the same time continue to try to grow the value of the assets that we own in the portfolio.
I see. Okay, yeah, the next question is seven warehouses in Panvel. Clint terminated a master lease agreement with Arcia in July 2024. So what is the impact of the rental income since then till now?
In the first 5 months of since termination, we clocked about 2.5 million square feet of net negative impact to the portfolio. From that, we would expect that to continue for the next 4 to 5 months as well, because we are what has changed is that in December we have since the termination we have taken over the properties. We have put in place the white collar operating teams. We have onboarded the blue collar workers that are there to provide value add services. We have entered into we are entering into contracts with tenants. Close to 40-45% of the rental income from tenants has been already secured. By end of March, we expect to secure another 40-45%, and by June, we should be securing we should be getting back to a situation that was pre-existing in June 24. The same situation should get reflected by June 2025. So the second half of the year, we would expect the negative contribution to fall off, and the positive contribution towards the unit holders' bottom line to start contributing for this asset.
Hmm, okay. Um, what do you mean by trustee manager does not hedge equity?
We only hedge the debt between 50 to 75% of the debt portfolio that we have. The equity investments that go in are not hedged. So our hedging policy is only for the liabilities that we have for external third parties that we hedge, because that is what you really are going to be worried about in terms of, because there are timelines in which these liabilities might will have to be retired, and you don't want to be caught in a cycle wherein the value of the INR has depreciated significantly and you're struggling to repay your liabilities. The equity investments that go in, they are held in Sing dollar terms. We expect like I said, the excess returns that we are able to generate in these assets to compensate for the risk that the equity is putting in terms of the INR depreciation.
Okay. What is your FX hedging strategy for income? How many percent of income is hedged?
We hedge the most recent distributions. We hedge about 50% of it. What we expect to distribute in the next half, we hedge 50% of that distribution at the portfolio level.
Okay, yeah. Are there any rental escalations for the portfolio?
We do see significant reversion of rents across three of our parks, which is in Bangalore, in Hyderabad, and in Chennai. These are closer to 8 to 9% range, which we observed in the last full year 2024. We do expect some positive similar reversions to happen this year as well in these three key markets. We are also able to unlock better efficiency in terms of the net leasable area itself. What we are doing is, we are able to go to tenants and say, if somebody is occupying 100 square feet of space, the tenant vacates. When a new tenant comes in, we are able to lease the same space for slightly better than 100, usually about 108. And the rationale we give for that increase of 8% to 10% is that we are providing a lot of common area amenities for the tenants. These are things that help the tenant attract better talent and manage their workforce better. So we are trying to load some of those common areas which their workers, their employees use onto the tenant leasable area. So there is a rental reversion as well. There is a slight improvement in efficiency of the leasable area as well. So both these should contribute to a positive rental reversion over the course of the next 12 to 24 months.
Yeah, that's helpful. What about during the course of the lease? So are there any inbuilt rents escalation over like annual escalation for the lease? Yeah.
Annual escalations, there are two types of contracts. A bulk of the contracts have a 15% escalation every 3 years, effectively about
Mm,
4.5% increase every year. About 30% of our contracts have annual escalations as well of 5%. So on an average, between 4.5, 5% organic escalation is something which we have within our portfolio.
I see. That's quite a high number. Um, yeah, so next question is, can we give some insights on portfolio valuations? What drove those gains as it rose quite significantly?
There were two key drivers. The first on the business park side, MTB6, which was held at cost in terms of the development. The occupancy certificate came about. So the building is complete, and most importantly, the building which we would have expected about 18 months to take to lease. Typically, we underwrite a 18 months lease up time frame for any new property that we acquire or we develop. Because of the efforts that we were able to put in and because of how India is growing, has been 100% pre-leased. So what was expected to be full rental starting, say, second half of early part of 2027, we are able to achieve that full rental starting May 2025. So that had a significant uplift in the value of the asset. So that is one. Similarly, in terms of data centers, which we were developing, particularly the Navi Mumbai data center, like I said, we were able to, again, for data centers, we underwrite something like a 30-month ramp up timeline for leasing. But no, because of the efforts that we were able to put in, but because of the team, the quality of the team that is there for the sponsor managing data centers and marketing those, we were able to fully pre-lease the data center that was developed and also show good visibility into take up of the second tower that is coming up in Navi Mumbai as well. So the timelines, like I said, the 30 months timeline got crunched in, and we are able to recognize revenue, full revenue, starting. I mean, we'll be starting the revenue recognition in May 2025, and by end of December 2025, we will have full revenue recognition. Whereas this should have ideally taken somewhere in the second half of 2027 and early 2028. So these two as well have contributed to the significant impact in terms of the valuation. And these are the two numbers which have caused the valuations to drive up. A reflection of this, I mean, there may be questions in investors' mind. Is this something which is being too aggressive? But we would want to give comfort that we are having discussions with private equity investors through the sponsor data center fund, and we are fairly certain that the data center valuation that we have shown, we should be able to achieve. It will still be plus or minus 10% up or down, but we should be close to where we are in terms of the valuations for the year end of 2024. So that's the reflects the value that Clint has, the intrinsic value that Clint has, which is still not being recognized by the market. At some point in time later this year, that will get unlocked, which will be an event which will prove to the market that these assets are valuable assets and are valued very highly by the private equity market.
I see. Okay, and moving on. What is the power capacity secured for the DC developments, and are these built to suit or co-location?
All our entire power capacity has been fully secured across all of our parks. Power is not an issue. We have, in fact, no, all our parks have no GIS gas insulated substation, supporting these data centers. So no issue, unlike in the other markets where it takes sometimes 5 to 6 years to secure power. No, these are fully secured. That's what makes it most attractive for hyperscalers when they look at us. These are not built to suit. These are colo services. But as we have noticed in the first data center, it's been 100% taken up by a single, though it is colo, it is 100% taken up by the hyperscaler. It is also a reflection of the quality of the team that is there in India running the data center, because getting qualified as a vendor for a hyperscaler is a very, very laborious process. Not many get qualified. Once you get qualified, you are in a bit of an exclusive club with, in terms of being able to service the needs of the hyperscaler. We have not only just qualified, we have been able to sign the agreement with the hyperscaler, and also have them pre-commit to something which we are going to develop in the future. So that augurs really well for the data center portfolio that we own.
Mm. Okay, how resilient is the Indian economy currently when regional markets and China are all down? How does this affect Clean's returns to investors?
India has always, if you look at historically, India has, whenever there has been an economic challenge elsewhere, and this goes back to the, Southeast Asian crisis of the late 1990s. Since that time, India, doesn't run as quickly when the others run quickly, but at the same time, it does well when the others slow down. India continues to grow at its own pace. Significant growth has happened in India since 2014. A lot of investments in infrastructure, a lot of policy changes, a lot more talent availability and attractiveness for global, organizations to set up shop in India. The growth rates are expected to continue between 6 to 7%. Global corporates are continuing to take up space. We have in most of our markets, we have RFPs from global corporates trying to set up shop in India. Like in Bangalore, you already have something like 5 million square feet being floated around, which wasn't the case last year or the year before. So far so good for India. It is expected to grow. I mean, our discussions, we continue to discuss with our tenants who are in the service industry. We continue to spend time with the brokers who are mandated to find space for tenants in India. Uh, all the feedback that we get is we are going to have a good 3 to 4 year run, and so business parks as an asset class is going to continue to remain really, really attractive. It's mainly important because of the infrastructure growth. For example, our Bangalore property ITPL, the metro line connectivity became live in the middle of 2023, in the second half of 2023, and in 2024, by the end of 2024, our rental reversion was quite significant. For numbers, building number 5, which we built in ITPL, was rented at about 54 rupees in 2021. Building number 6, which we have signed up with the semiconductor industry client, is renting at about 74 rupees. So which is like a 40% increase over a 3 year time span. That is mainly because of the infrastructure availability, the metro line getting opened up, making it easier to access our park. This is happening across the country. You'll find metro connectivities being built up across all the cities. Any city you land, you'll have traffic jams, and one of the main reasons of the traffic jam is because the pillar work for these metro lines are being constructed. So things are looking good and positive for India, at least over the next 3 to 4 years.
Hmm, okay. Do you need to cut your DPU in Sing dollar due to the depreciation of the Indian rupee? Is there a minimum DPU level you are committing to for the next 2 to 3 years? And do you have any guidance for the short term or CAGR over the long term for DPU?
We distribute 90% of the income, every year. So so if yeah, yeah, it is embedded in the the distribution itself. So however the INR moves, and that's what, like I mentioned before, we try to hedge 50% of the distribution for at least 6 months or beyond. So we try to reduce that volatility, but we distribute. We don't decide what DPU to distribute. It is we flow through 90% of the income that is made. We distribute it to the investors, and it flows through. And we don't make any forward projections of DPU
Mm,
for the market.
okay. And can you give a sense of the competition and market dynamics in the Indian commercial real estate sector over the next 3 years? Like, who are the main players and what would the impact be on occupancy rates and rental growth?
India, as of so there is a pre-COVID, India was a very, very distributed market. Now, if you go to any city, you will find like a dozen developers, putting up business parks across the city, and pitch the same one to tenants, and tenants were largely driven by the commercials, without spending too much time on the quality of the landlord, or the quality of the services that the landlord will be able to provide. All of that has changed since COVID. So if as of today you'll find a lot of consolidation. There are 5 to 6 leading developers, us being one of the biggest. You have the likes of Brookfield, Embassy, K Raheja, DLF, and RMZ. These are the pan India grade A developers, as you call them. Most of the quality tenants you will find picking one of these developers to set up their space. And The market is, like I say, consolidated, because you will find a local developer grade A building having 0% occupancy. Like in ITPL, I can give a live example for ourselves. Our building is not yet developed, it's fully pre-leased. On the same road, literally at the next metro stop, 1 kilometer away, you have a brand new, really well built grade A building which has been vacant for the last 18 months, a very low occupancy. Reason being, it is done by a local developer whose specialty is residential. So the tenants are worried that you know once we step in, move in, the local developer is going to sell this property and then we are going to suffer. So they, no matter how low the rentals that they are quoting, tenants don't want to risk their long-term interest and employee welfare in the hands of a local developer who doesn't know what he is getting into. So there is a lot of consolidation. In the consolidation, because all of the 5 6 developers are either listed entities or REITs and are well managed corporates. um, uh, Nobody makes irrational investment decisions. So all of us consider what products are going to, who is developing what, when is that product going to go live, is that, are we going to compete head on with them, is that going to have an impact in terms of our leasing velocity or the rentals we can achieve. So these are well thought through. So at least at this point in time, there isn't any overhang of supply from any of the top developers in any of the markets. So whenever we bring new product to the table, it gets leased up in fairly short time span.
Okay. Is Applied Materials doing equipment production in India?
Um, it is actually doing more of design and R&D, but they are setting up labs, and there is a possibility that they may start manufacturing their equipments and then shipping them out.
Hmm. Okay. Uh, when will Clean divest two mature IT parks? Will it affect the DPU or any changes of given special DPU due to the divestment?
We do expect that divestment to happen in the first quarter itself. I mean, we were trying to close it by end of this month, and it could, if any, it could slip into the month of March. It should not impact DPU, because these proceeds will be largely to retire debt. So your interest in expense is going to significantly come down. Notwithstanding that, for the first time we are considering carving out. I mean, we'll also be able to display to the market the huge profits one makes in terms of, in addition to the rental yields, there is also the capital appreciation, the crystallization of that will happen. We will now have a numeric example to show to the market how not just the rental revenue but also the value appreciation gets crystallized and passed on to the investors directly or indirectly. We do want to carve out a portion of the profit, maybe 10 15%, and distribute it to investors over a period of time. We still haven't decided what is that period of time, how much is it, but we are definitely considering that as a part of this divestment.
Okay. Um, Tata has 11% and Infosys has 6% of Clean's base rent. What are your backup plans should they decide to terminate their contract with Clint?
It's not so straightforward because these are distributed across multiple buildings, and these are distributed across multiple contracts. All these contracts are not coterminous, so there is no, even if they decide to not renew a contract and terminate, they need to give us a 6 months advance notice, and that will happen over a period of time because Tatas have been taking up spaces from us for the last, like, 12 to 15 years. And no, they signed up most recently, 3 years back. So it'll be different stages of leases that they will be into. It is not possible for them to sort of suddenly stand up one day and say, okay, I'm going to terminate all my leases, and so this entire 16-17% of the portfolio is not going to come to the market on one day. It'll get broken up, and even if they decide to terminate, it'll be over a period of 3 to 4 years, which means that it'll get distributed over those 3 to 4 years.
I see. Okay, what is the turnaround time when a tenant decides to vacate, and how long in advance would the landlord be informed of his intention to move?
Typically, contractually, they are required to give us a 6 months notice. So generally, you get that 6 months to go and find a newer tenant, and then the handover process is, it usually is not more than a month or two at max. Sometimes it's just back to back. They may, they'll, it's a 6 months notice, but typically a tenant, when he moves out, he moves ahead of the 6 months itself. But we will charge him for the full 6 months. So usually there is not a material significant dip in the rental income during the transition phase. And also most of the cases you will have a rental reversion. So the increased rental kind of compensates for that month or two that you may lose in the transition phase.
Okay, since we're on the topic of rental reversions, what is the outlook for 2025?
Like I mentioned, we do expect no rental reversion to be 5% plus for these three markets, no primarily, which is ITPL in Bangalore, ITPH in Hyderabad, and ITPC in Chennai. We could do better as well, but it's not just the rental increase, but also the area. For the same
Mm,
building, we'll be able to have a slightly larger NLA whenever a lease goes to market. If it's a existing tenant renewing, he'll not increase the area. But if it goes to market, we are able to increase the area. So that is also a form of reversion that we'll have.
I see. Okay, what is the cost of debt expected for FY25?
Right now, we do expect it to be similar to where we are, about 6%.
Mm,
It could move a little bit here or there, but at least at this point in time, we are not able to give any more guidance on that. It should be around the same 6%.
okay. What is your yield spread or carry spread, meaning property yield over cost of debt?
We have, like we said, no, we are clocking about 6% in terms of the interest cost, and we generally clock about 9 to 10% in terms of rental yields. So that's the delta you have. About, it could range between 300 to 400 bips in terms of the accretiveness of the rental yield.
Okay. Um, can you talk about the potential for M&A? Do you still see room to acquire more assets at attractive valuations? If so, how would you find it given that gearing is already at 40% and share price is depressed? Do you rule out any EFRs at depressed share price levels?
Um, M&A activity, I don't think, in the traditional sense, we're going to look at larger portfolios. There are a few available, but like I said, our focus has largely been in terms of doing transactions which are accretive to investors. It's in our DNA that we until unless there is some strategic view, we don't want to be paying market price for any acquisition. We want to be paying lesser than market price, and we have been successful in acquiring these assets at 15% discount to their fair market value for a consistently long period of time. And also the uh, developments that we do, they are very, very accretive, because these are lands that we have acquired at a very, very low basis historically. So when we develop, our rental yields are very, very strong on those developmental assets. So therefore, third-party acquisitions, bulk acquisitions, I would say, kind of very unlikely until it is really, really attractive or strategic. We are aware of the gearing. It is at 38.5, and if you actually, we have cash on hand. If you include the cash, it actually is below 37. It's about 36.6 percentage is the gearing, which is very attractive in its own as compared to some of the others in the S-REIT universe. But still, we are cognizant of that 40% number that is in everybody's mind. So the strategy that we have adopted is to do recycling through divestments, which is why we are looking to divest a couple of business parks early this year, and the divestment of the stake sale of the data center portfolio as well. So a large portion of the attractive investments that we already committed will be funded through recycling of assets, and through as the value of these assets go up, we do get a more headroom to raise additional debt. We'll continue to do that. Um, we are aware that no, at as long as the unit price is significantly below the NAV, it is not in the interest of the unit holders to go for additional equity raise. So right now, that is not at the top of our mind, frankly.
I see. Yeah, that's very clear. Does Trump's new GPU export control limit India's future data center capacity?
Not really, because the hyperscalers that are operating, and those that we have signed so far, we can't take a name because of confidentiality. They are not restricted by those rules that Trump has come up with. Those guys can buy as many GPUs as they want.
Hmm,
Those restrictions are largely for enterprises outside of the US.
I see. It appears that foreign funds are flowing out from India back into China. Any comments on this?
Um, I mean, there may be some truth to it in terms of the equity markets, and this when China announced its own liquidity impetus, that last end of last year. But otherwise, we do find still a lot of funds coming into India in the real estate and infrastructure space. That continues to attract a lot more capital, and we have been the sponsor has been looking to raise private capital in India, and have been successful at raising some of those capitals. We do find a lot of institutions looking to set up new shops in India, and they we pitch our business parks to them. So I don't see that in any significant impact being or impact being felt in the real assets side of things, at least at this point in time.
Hmm, okay. Clint is heavily exposed to business park assets. Is management looking to diversify more into other industrial asset types for better risk management? And are there any target ratios for other asset types or target dates to achieve such diversification?
Diversification is important. I mean, just to clarify, I mean, of course, no, for the simple, straightforward question is yes, we are looking to diversify the portfolio, and that's the reason why we first in 2018 we entered into the industrial space much ahead of time, when industrials were not a really flavor of the season. They became the flavor of the season post COVID. Similarly, we entered into data centers in 2021, when again data centers is not flavor of the season. That happened in 23 and 24. So diversification is at the top of our mind. We do want, ideally speaking, we would want kind of like a two-thirds, one-third, two-thirds in business parks, one-third in the other two asset classes. But I do want to also mention that the business parks in themselves are diversified across industries. So like in the slide that I showed in terms of the tenant mix, the business parks themselves are not sort of concentrated in a few industries. They are pretty spread out across multiple industries. So in itself, there is a diversification, and also that across different cities in India, we are diversified as well. So there are multiple levels of diversification. Risk management is something which we think about very seriously. Protecting the capital of unit holders is something which we take very, very seriously. Not just us, also the independent directors that are there. No, they are very hawkish about it. So we will continue to monitor this. I mean, I'm not going to be able to put any timelines, but as you can see in our portfolio, no, we are making the right moves, and we have been doing it consistently over a period of time. So we will do whatever is in the best interest of the unit holders in terms of diversification.
Hmm. Okay. Does Clean take loans in India or in Singapore? And what is the overall cost of the loan? I mean, you said that was 6%. And where do you see the trend? Yeah, you also answered that part. So just the loans.
Historically, there was a benefit in taking a loan in. It was one of the benefits that accrued to us because of us being in Singapore. You could borrow cheaper in Singapore, convert it into INR, no, through swaps, and then send it to India. And if you compare to the local lending rates, no, there was a clear 200 basis points delta. You borrowed at say 2.5% in Singapore, swapped it at about 4% plus, so it's 6.5%. You, if you look at India, it used to be about 8.5%. So you had a 200%, two percentage points or 200 bips delta, which was to our benefit. But in the current interest rate environment, things have changed. Since COVID, when the interest rates started going up, in the globally interest rates went up by about 400 basis points plus. India interest rates went up only by about 200 250 basis points. So the delta that we had doesn't exist anymore. So today, if you borrow in Singapore, swap it and send it to India, your landed price is about 8%, 8.5%. Which you borrow in India, it's the same. It ranges between 8 and 8.5%. So as of today, the delta is not there, and that's the reason why we are looking to borrow more in India. So our data center portfolio construction, rather than borrow in Singapore and send to India, all the capex is being funded by loans that are set up from institutions in India. So the cost on a hedged basis remain the same, but the benefits that you get is, if you're borrowing in India, one, you get the full tax shield effect. So you can offset your interest expenses against your income, and that, so your after post tax shield, your effective interest rate becomes about 6.5%, which is a good benefit. So we are going down that path. So going forward, we'll be looking to take more loans offshore in onshore in India. It could be through the financial institutions. We are also looking to see if we can raise some INR bonds by getting some of our assets pulled in and rated. So all these are things that the finance and treasury department are really looking at doing in the near future.
I see. Okay. What is Clean's current market share in the Indian data center market? And how do you differentiate your DC services from competitors? Like,
Okay.
what are the unique selling points you offer?
Yeah. I mean, it's a little difficult to talk about market share. No, it's very early days. No, there are a lot of announcements that have been made. So it depends what is the what is the comparable set that you take. But 250 megawatts is a significant chunk. So today we will be considered among the top five players that are operating in India. We have arrived in terms of an operator, so to say. So any client that gets to India will consider us quite seriously, because we also have a portfolio to offer. It's not just a single location operator. No, we are across the four key markets, and Capitaland is a significantly large sponsor, and we leverage that brand quite significantly. Colo service is something which we differentiate ourselves. We have a full-fledged team in India, ability to provide colo services. Colo services, for those that may not be aware, means that we maintain the infrastructure, the cooling system, the chiller plants, the power, the DG sets, the power station, substation that is there. All of that, we maintain and monitor, and the tenant takes care of everything within the data hall. So all the servers and the networks and all of that is the responsibility of the tenant. We have got nothing to do with it, but we provide the full service in terms of maintaining the external infrastructure for the tenant. These services are provided only by, like I said, no, a handful, four or five, and the teams, our ability to set up the team way ahead of time actually augurs really well for us.
Okay. Following the launch of DeepSeek and several other AI large language model chat of competitors, the narrative on DCs appear to have shifted from bullish to neutral in Western markets. Appreciate your views on developments.
Um, I mean, this is a question which has come up quite a lot in the last couple of weeks, ever since before the Chinese New Year. Um, the key question, I mean, for a parallel, it's just an example that, for more simplistic understanding. Um, if you go back to the 1970s, it was the, US car makers, automakers that dominated. They were energy guzzlers. Their fuel efficiency was next to nothing. When a much more fuel efficient Japanese car was introduced to the market, and they were cheaper, more fuel efficient. Yeah, probably they did not have the same power as as the as the American cars, but they were very very practical. So the effect what it was that when you introduce more fuel efficient cars, it made it more affordable for people to purchase, which increased the demand for fuel. In a way, the problem that they are trying to solve was reduce the dependency on oil for automobiles, but putting in fuel efficient cars meant that no more people were consuming no more fuel than before. So the demand for oil actually went up after introducing fuel efficient cars. Something similar is what is expected to happen due to DeepSeek. DeepSeek, what did it do? It proved to the market that one, you did not spend $100 million to train your model. No, your modeling cost is going to be 1/20th. No, the quoted price is about 5 to 6 million dollars is what the team spent on training the model, as against 100 million of OpenAI. And also the cost of setting up your infrastructure is significantly cheaper. What it means is that today any enterprise, because it's open AI, any enterprise can go take a data center colo space, set up their servers, download a DeepSeek into their servers, ring fence it from all the outside universe, put in, let's say DBS can dump in the data into those servers, run their own LLMs, SLMs, engage a IT company like a TCS or a Infosys to develop apps that benefit out of the LLM models that are there in the as the underlying output from these AI systems that they have, and are able to provide better service to their eventual clients. This wouldn't have been possible if not for no open source codes like DeepSeek. If it was obnoxiously pricey to set up, no, you can't, you can run DeepSeek in chips that are freely available. You can run OpenAI LLMs only in the hi-fi, no high-end GPUs, which are restricted to purchase. So there are no barriers to entry today. So when you remove barriers to entry, there is much more democratization of the field. Many more players will come in and play, and the demand for the data center space is actually expected to do better than what it was before. So many of us see it as a net positive to the data center industry and not as a negative in the long run.
I see. Yeah, that's clear. Mm. Pre-leased 100% of MTB6 at IT Park Bangalore. When will it start contributing to the bottom line of Clint and also the DPU?
From May 2025. From May
Okay.
of this year, you will have revenue recognition and flow through to the DPU.
Mm, okay. How will Clint manage its capex and funding requirements for its data center expansion plans?
Like I mentioned before, it's going to be a mix of divestment of some of our business parks, divestment of the DC stake sale itself. So when we sell 33% down to investors, we are going to sell it for a profit. So not only are going to get back capital, we are going to get a significant profit as well. That will be pumped back, put back into the capex that is going to be required. But when we sell, what today we are responsible for 100% of the capex. Once we sell, we are responsible only for 66% of capex. So our capex requirement itself goes down through the part sale of the DC portfolio. And like I said, no, as we improve our valuations, as we sign up more tenants, the value will increase, which means we'll have more headroom in terms of the debt which we can draw down, keeping 40% as kind of like the benchmark which we don't want to, or the benchmark which we don't want to breach. So these are going to be some of the methodologies or no processes that we are going to try to implement over the course of the next 12 months to ensure that no the capex, we have a great pipeline, and we do recognize no that the capex is going to be at the top of unit holders mind. We have a game plan to put in place and meet those capex requirements.
I see. Okay, how much do you expect to raise from the sale of the stake in the DC assets, and how will these proceeds be deployed?
I don't want to speculate on a number, but I would say, the valuations of the data centers are, in the public domain. So, that is 100% of the value. We would expect to generate somewhere close to that. That'll be the enterprise value kind of, the valuation kind of. So, 33% of that is the value we would expect to make on those. It could be plus or minus, 5-10%, depending on who we negotiate with. Sometimes we could be, we get the right investor, we could be, slightly higher than that. But, if we want the right partner, sometimes we may have to compromise a little bit on the value, then it'll be slightly lower. But that's a good ballpark estimate of what we'll be able to generate.
Hmm, I see. Okay, yeah. Thanks, Mr. Gauri, for answering so many questions, 30 over. Yeah, unfortunately, there's still about 20 questions that we are unable to answer due to a shortage of time. Yeah, so I'll just leave the last couple of minutes to Mr. Gauri for any closing remarks that you might have before we end this webinar.
Yeah, thank you. Happy to, I mean, if you could share some of the unanswered questions, happy to work with my
Yeah,
team
sure.
and reply to them via email so that everybody benefits. I just wanted to give assurance to all unit holders that, what we are trying to concentrate on is trying to protect and enhance the value of the units for the unit holders. Capital India Trust has been there for a very, very long time. It has a long history, and you would be hard pressed to find a situation wherein Clint was, took a decision or made a move which was not in the interest of the unit holders. And there's a consistent performance. The performance, drop was largely a reflection of the interest rate environment which happened. Operationally, we are doing exceptionally well. It is the interest rate environment which has kind of dampen the mood, not just for us, across the entire REIT universe, across the globe, but even within the REIT universe, in the S-REIT universe, will be among the top 4 or 5 performers, over the last 4 or 5 years. And we will continue to concentrate on improving the operational efficiency, do better deals, more accretive deals, and we'll be continue to be more creative about how we source our capital. We are aware, not trying to raise equity when the value is not at a discount, when the unit price is at a deep discount to the NAV, is not something which is in the interest of the unit holders. So that is the last thing we would want to do. But there is a lot of value in the price as of today. If you read some of the analyst reports, the market has pretty much given zero value for the data center play that is there. Which I believe is something which is going to get unlocked later this year, and at which point in time the price should rally further. So if you are looking to make extra normal returns in the immediate term, Clint is a stock which you definitely want to kind of be a little bit overweight, or spend more of your portfolio in, if you're looking to make extraordinary returns over the course of the next 12 to 24 months. So that'll be my pitch for the investors. And once again, I would like to thank all the participants. Really appreciate you being on this call, and feel free to reach out through us. At any point in time, we are more than happy to share more details, to help you come to the right decision.
Yep. Once again, thank you so much, Mr. Gauri, for your presentation and answering so many questions, as well as the attendees for so many questions. Yeah, so that brings us to the end of our webinar. Hope to
Thanks.
see you of future webinars, and yeah, thanks
Yeah.
again,
Thanks, Darren,
Mr.
and
Gauri.
thanks to Philip Securities for being such a gracious host. Really appreciate it.
Yeah, thank you so much, Mr. Gauri.
Yes, cheers everyone. Have a good day. Bye
Yeah,
bye.
you end the webinar here. Thank you so much. Bye bye. Have a good day.